Imagine it is 15th of September 2008. You're a 39-year-old office manager living in Phoenix, Arizona, United States. Your stucco house sits at the end of a cul-de-sac, lined with young palm trees and identical mailboxes. 2 years ago, a real estate agent told you the place had gained more value in 12 months than you had saved in the previous 5 years. You still leave for work at 7:10 every morning, coffee in a travel mug, your daughter's backpack in the back seat, and the radio talking about gas prices and election polls. Your retirement account feels boring and distant, but your house feels alive, like a second paycheck, quietly growing while you sleep. The neighbors talk about granite countertops, backyard pools, and which street might hit $500,000 first. If you have ever wondered why homes can feel safe right up until the moment they become dangerous, stay with me. What you are about to hear is not a theory. It is a pattern. It has happened before. And it does not need the same flag, the same language, or the same decade to produce the same kind of damage. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Then the day changes. Lehman Brothers files for bankruptcy that morning. The stock market convulses. And in your own neighborhood, the for sale signs begin to look less like invitations and more like warning markers planted in dry ground before a flood. The house across the street cuts its asking price again. Another neighbor stops waving. Someone says a lender backed out the night before closing. The strange thing is that nothing physical has happened to your block. The roofs are still on. The lawns are still green. The school is still open. But the value everyone thought was solid turns out to be like frost on a window. It looked thick. Then the sun came up. This video is about that frost, about the housing bubble governments often refuse to name while it is growing, because rising home prices make too many powerful people feel richer, safer, and more successful than they really are. History shows that housing bubbles do not always look the same on the surface. Sometimes prices crash hard. Sometimes they stall while incomes fail to catch up. Sometimes construction stops, debt remains, and a whole generation discovers that shelter has been turned into a machine. But beneath the paint, the beams are usually the same. Cheap credit, political incentives, public reassurance, and ordinary people mistaking rising prices for lasting wealth. Before we go further, there is something important to understand. A housing bubble is not just a story about expensive houses. It is a story about what a society decides a house is for. A home can be a place to sleep, raise children, and store the ordinary pieces of life. Or it can become a chip in a giant national casino. When that happens, the market stops behaving like a neighborhood and starts behaving like a hall of mirrors. Prices rise, and the rising prices become the proof that prices should keep rising. Banks lend more because homes seem safer when they are getting more expensive. Buyers rush in because waiting feels like losing. Governments enjoy the mood because construction lifts growth, property taxes fill budgets, and voters who own homes feel wealthier. The whole system begins to balance on a monthly payment. That payment becomes the narrow wooden bridge holding up a very heavy parade. If rates fall, the bridge seems strong. If rates rise, wages slow, or credit dries up, the bridge begins to crack. And here's the part most people miss. A bubble can exist even when there is a real housing shortage. It can exist even when people truly need homes. The bubble is not the need. The bubble is the price of that need being lifted far above what normal incomes can safely carry. Because debt, policy, and hope keep pulling together in the same direction. Once you see that, 100 headlines start saying the same thing. And now we reach the most uncomfortable part of the diagnosis. Governments almost never like the word bubble, while the bubble is paying the bills. They prefer words like shortage, momentum, resilience, or temporary imbalance. Sometimes those words describe a real part of the picture, but they can also function like curtains over a cracked wall. The state gets stamp duties, permit fees, and happier homeowners. Banks get collateral that appears stronger every quarter. Developers get political attention because cranes and ribbon cuttings look like progress. Even voters who feel uneasy about prices may still enjoy seeing the value of their own home rise. So the warning arrives in a room where almost everyone has a reason to mishear it. That is why housing bubbles are so often denied in plain sight. They are not hidden because no one can see them. They are hidden because too many people benefit from seeing them as something else. This brings us directly to Japan. In the second half of the 1980s, Japan looked unstoppable. Factories were humming, exports were strong. Tokyo seemed to stand at the center of the future. Then housing and land stopped being ordinary assets and started being treated like enchanted soil. According to the IMF, in the second half of the 1980s, Japan's stock prices tripled and land prices doubled. One estimate in late 1991 put the total land value of Japan near $20 trillion, more than a fifth of the world's wealth at the time. That number sounds absurd now. It sounded impressive then. That is how bubbles work. They turn absurdity into a status symbol. Banks lent freely. Interest rate and credit conditions helped drive the rise from 1985 to 1989. As researchers Douglas Stone and William Ziemba wrote at the time, companies borrowed against land. Families believed land could not really fall for long. In Tokyo and Osaka, the price of place itself seemed to have detached. A home was no longer a roof. It was a passport into a rising national myth. Imagine being a mid-level salaryman in Chiba in 1989. Your train ride into Tokyo is crowded, your apartment is small, and yet everyone around you speaks as if owning even a modest piece of land is the closest thing to guaranteed success. The country had spent decades climbing. Why would the staircase suddenly end? But a staircase can become a ladder leaning into empty air. Tightening came. Confidence changed. The bubble broke around 1990, then came the long shadow. The Bank of Japan later described that second peak around 1990 as a malign bubble that triggered a long period of stagnation. Stagnation means the economy stops moving with its old energy. It is like a bicycle that remains upright, then begins to wobble. Per-person economic growth in Japan fell from above 3% to around 1% after the collapse. That is not just a statistic. That is years of smaller wage gains, weaker hiring, lower confidence, and families postponing decisions. The surprise is not that Japan had a bubble. The surprise is that the bubble was easier to celebrate than the damage was to reverse. Property did not just inflate prices, it reordered the whole economy. Debt sat on balance sheets. Banks turned cautious. People who thought land made them rich discovered that paper wealth can vanish without the building changing at all. And this is where history gets uncomfortable. A housing bubble does not need a dramatic bank run on day one to do its worst work. Sometimes it does not explode like dynamite. Sometimes it hardens like concrete around the ankles of an economy, slowing everything for years. Japan was not undone by one bad afternoon. It was undone by a long misreading of what rising land prices actually meant. There was another twist in Japan that matters today. Land was not just something people owned. It had become the thing banks trusted most. When property values rise, collateral rises too. Collateral means the asset a bank can grab if a loan goes bad. Higher collateral lets banks lend more, which pushes prices higher, which then creates even more collateral. It is a feedback loop, which means an echo that grows louder because the room keeps repeating it. During the bubble years, that loop made Japan seem stronger. After the bust, the same loop ran in reverse. Banks faced bad loans. Borrowers cut spending. Companies protected themselves instead of expanding. The very asset that made the economy look indestructible became the channel through which weakness spread. That is a lesson governments still struggle to accept. Housing bubbles are dangerous, not only because prices can fall, they are dangerous because an economy built around rising land values becomes less flexible, less honest, and less able to admit mistakes. Here is something I want you to think about. If a home becomes so expensive that it only works when rates stay low, is that value? Drop your answer in the comments. Seriously. Because what I'm about to show you next is the part of the story that most people never hear. And it changes everything. This leads to the second part of the story. The United States did not repeat Japan exactly. It repeated the deeper logic. American house prices peaked in mid-2006. By the third quarter of 2008, the national index was down 21%. In Phoenix, Las Vegas, and San Francisco, the cumulative falls from peak levels were brutal. Phoenix alone saw year-on-year prices down 31.9% by the third quarter of 2008, and the cumulative drop had reached 38.5%. By then, the United States also had an excess stock of about 1.2 million housing units, a backlog of empty homes. On paper, the American housing boom had many moving parts. Mortgage brokers pushed risky loans, and Wall Street turned them into securities, which means bundles sold onward like sealed boxes whose contents few people wanted to inspect closely. Ratings agencies blessed them. Regulators moved slowly. But the center of the story was simple. Credit had been made to feel harmless because rising prices erased mistakes. If the borrower struggled, refinance. If the payment reset higher, sell. If the appraisal looked generous, borrow more. The machine fed itself. It was a snake swallowing its own tail and calling that growth. Then prices stopped rising. Once that happened, every promise that depended on tomorrow's higher price began to unravel. In 2008, Pew Research found that 2,383 homes in the United States had at least one foreclosure filing. In Lee County, Florida, the foreclosure rate hit 12%. 12%, more than 1 in 10 units touched by foreclosure. That is not a housing statistic. That is a social injury. It meant moving trucks, children changing schools, and couples fighting over bills. Pew also found that counties with higher shares of immigrant residents were associated with higher foreclosure rates. In plain English, the pain was not evenly spread. It hit hardest where people had thinner cushions and less room for error. Governments did respond. Central banks cut rates. Banks were stabilized. Emergency steps were taken. But one lesson remained buried. Housing bubbles survive for a long time because rising home prices do political work. They make the economy look stronger. make households feel richer, and make local governments flush with taxes and fees. When someone warns that prices have drifted too far, the warning sounds rude until the floor gives way. The American crash was a failure of imagination. Too many people could imagine prices rising forever. Too few could imagine what a whole suburb looks like when trust leaves first and prices follow after. In 2008, the problem was that too many balance sheets had been arranged around home prices that needed perfect weather forever. A market can survive high prices. It can survive high debt. It cannot survive high prices and high debt and blind confidence together. That stack is a tower made of dinner plates. It looks elegant until one vibration reaches the middle. Then stability becomes stillness. The official language before the break was often soothing. Risks were said to be contained inside a safe box. But housing risk was in driveways, pensions, municipal budgets, bank funding, and the expectations of families. When a government refuses to say the word bubble, it is because saying the word would force them to admit that growth is fragile. Now observe Spain. Between 1995 and 2008, Spain saw a threefold increase in housing prices and in the number of new houses built. Cranes towered over Spanish cities and coastlines like a second skyline made of steel. Construction became a national weather system. It touched jobs, banking, family plans, and politics. Real GDP in business grew by an average of 3.8% a year. Credit surged toward property. The share of construction and real estate in total firm credit rose to 48% in 2007. Spanish banks' external debt almost tripled between 2002 and 2007. Financial blood was pumped toward land and buildings. Imagine a clerk in Madrid in 2006. Everyone seems connected to the boom. Owning feels grown up. Renting feels like missing the train. This is the emotional core of a bubble. It tells an entire generation that caution is immaturity. Then 2008 arrives. Demand weakens. Credit tightens. By 2015, Spanish house prices had fallen by a third from the peak. Real GDP fell for 5 straight years. The forest of cranes turned into a graveyard of paused ambitions. Families who bought near the top were trapped by fixed debts. Spain exposed another truth. A housing bubble is often mistaken for prosperity because it creates visible activity. But visible activity is not the same as durable wealth. A sandcastle is visible too. The tide does not care. When housing dominates growth, a country can look healthy while quietly turning its future into drywall and debt. Most people will never know what you now know. Hit subscribe. Observe what all of these cases have in common. Japan, America, Spain, different countries, different decades. Same result. Housing stopped being priced as shelter and became a strategy. That is the mechanism, not greed alone. A whole alliance between cheap credit, political incentives, and cultural hope. In Japan, land soared on loose credit. In the United States, the mortgage machine spread risk and people mistook dispersion for safety. Mechanism. Easy credit, prices rise faster than normal incomes, officials use soft words, ordinary people adjust, then the truth changes. A housing bubble is a lie about time. It borrows confidence from the future and spends it in the present. Between 1992 and 2006, Irish house prices rose 300%. Loan-to-value mortgages became widespread, leaving no cushion. Ghost estates sat on the landscape like smiles with missing teeth. Ordinary households who trusted respectability suffered most. China's Evergrande model. Borrow to buy land, sell homes before built. Liabilities reached $300 billion. Companies accounting for 40% of Chinese home sales defaulted. Families paid for apartments they could not move into. Today, housing is less affordable than before 2008. Affordability indices in the US and UK have plummeted since 2021. A market does not need to explode to break people. It can simply remain out of reach for long enough to alter trust. High prices are politically useful because they flatter balance sheets and help banks look secure. Survivors kept a margin of safety, refused to confuse an asset with a life plan, and were willing to look foolish during the boom. Caution is not pessimism, it is memory. Returning to Phoenix, you discover a home can be trapped in a larger story. This is historical and educational analysis, not financial advice. Consult a professional before making decisions. Subscribe for more.